This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
If the Fed chair, Iran leadership, and Trump don't know where this is all headed, don't think you have the answer key. Instead, make sure you know what you own, why, when you need it, and how you might make out under different scenarios. Up next, with that as a backdrop, let's take stock of this ever-changing landscape. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Another crazy week. Now, the working title of this podcast is Don't Fear the Reaper. You remember that classic, right? The 70s rock classic from Blue Oyster Cult. I think it's about the inevitability of death and finding love that can transcend mortality. It's probably a little bit heavy for this podcast, but it did remind me of the idea of kind of what's going on, the angst of geopolitical uncertainty, the ability to look past it to the big picture. Maybe that's a poor analogy, but it's kind of what reminded me of this environment. And cut me some slack. I said this a couple weeks ago. Things are so volatile, not just on a day-to-day basis, but on literally a minute-to-minute basis. I'm not exaggerating with the headlines that, what I say could age poorly, but I think the longer-term concepts will age well. So just keep that in mind. But, obviously we all know that oil prices, can change by 20% literally overnight. So stay tuned. As I always say, I've said this a lot actually over the course of the last few years, but I'll continue to say it. Even though the circumstances are different each time, these are the fleas that come with the dog. Corrections, pullbacks. It's inevitable. It's inevitable. As our friends at Ned Davis Research have pointed out, going back to 1928, I think they went back to, we've seen dips of 3% or more on average, 7.2 times a year. Mild corrections of 5% or more, 3.4 times per year. 10% corrections, 1.1 times, and 15% or more, half a time. In other words, every 2 years. So again, the catalyst for these pullbacks can be just about anything. We have seen an awful lot just in the past decade, but these are typical. It was just this time last year, right? The S&P went down more than twice what the S&P has declined so far this time around. So we have lived through it. We've come out the other side. And remember, last year, of course, the markets rebounded to produce a double-digit return. So what happens in March or April is not necessarily reflective of how we're going to end up. Just keep some perspective. But listen, we're in an environment where the markets are reacting to social media posts and stories more to verifiable information. We don't even know what verifiable information is anymore. So we're going to continue to have this type of volatility. And we're being whipsawed all over the place, right? I mean, seemingly optimistic developments prove to be false hopes and vice versa. One minute we're told the war is ending, next minute we're escalating. We know all about this, right? I think the truth is, or at least the lesson, I should say, is that the markets tend to react more to things that were not anticipated. I've said this a long time. When everyone is talking about a risk, it doesn't mean that it's not a risk, but it means it's probably a lot of it's already discounted in outcomes, right? Because it's already been priced in. It's already built into the public consciousness and expectations. But I read something the other day that I think it was the Bank of America's Global Fund Managers Survey. Coming into this in February, just 14% of market pros cited geopolitical conflict as their top tail risk for the year. Only 14%. In March, that was up to 37%. So even though, there was some contemplation of Middle East conflict, this was a bit of a blind side, right? Which is why we've seen such turbulence, not just in stocks, but of course in metals prices, commodity prices, and the bond market, which I'll talk about a little bit more. And we just don't know, whether the asset class reaction today is the right one. Barry Ritzel has a quote that I really like. He said, "The first draft of history is typically emotional, rarely accurate, and often conflicted." So I wouldn't be surprised if 6 months from now, We're seeing something different with stocks, treasuries, metals, commodities, right? But at first pass, it's kind of sell everything, sort it out later. As a result of this, it's interesting, I saw some data from FactSet over the past 50 market sessions, we've seen the most intraday reversals since the 2022 bear market and the period leading up to the great financial crisis. What does a reversal mean? It's when the market starts in one direction, goes back the other direction. So, for example, just on Thursday, just as I was preparing for this, the futures were down 400 points on the Dow. By 10 o'clock, they were up. The Dow was up 50 points. Okay? And we've seen that multiple times. So what's the lesson? The lesson is try not to be as frenetic as the markets are. And I say this all the time, but I just want to harp on this for a few minutes. Give me some grace here. Remember, the news is incentivized to address your interests as a reader, not necessarily your interests as an investor. Two different things, right? And there's a time horizon mismatch between news providers and investors, right? News articles are only highlighting what's going on that minute. They don't care about your 20 or 25-year or 30-year retirement plan, right? Totally different set of concerns. By definition, really, most headlines only have a day's shelf life. And keep this in mind. If you look at it going back 100 years, the stock market is up roughly half the time on a day-to-day basis. It's a coin flip on a day-to-day basis. All right? So, again, by definition, that means at least half of the days in any given time, the news flow is going to be negative, explaining why the market went down that day. Of course, the further you go out, your odds go up significantly. I mean, over the last 100 years, 5-year returns are positive about 90% of the time. I think 10-year returns are positive like 98% of the time. 20-year returns, 100% of the time. But on a day-to-day basis, it's a coin flip. So the news headlines are going to be a coin flip as a result. Larry Fink up at BlackRock, the largest asset manager in the world, he said the other day, I'll just quote from his annual letter, "We are living through a period where things that would have defined a decade have become routine. Wars with global repercussions, trillion-dollar companies, a fundamental reordering of international trade, the advent of the most significant technology since the computer," talking about AI. But the problem is we're seeing those generational things that are getting filtered through a short-term lens. And then he goes on to say, investing has mattered far more over time than getting the timing right. Over the past 2 decades, every dollar invested in the S&P grew more than 8-fold. You missed just the 10 best days, and you would have earned less than half of that. Some of the market's strongest days come amid the most unsettling headlines. The danger is we focus so much on the noise that we forget what actually matters, end quote. Okay, I'm not saying I'm as smart as Larry Fink, but that sounds a lot like what I've been saying for not during this recent turbulence, but really since I've been hosting this podcast and the radio show before that. Before I go on, just want to give you kind of one warning. There's a good article in the Wall Street Journal about this the other day from Jason Zweig, who I follow. The name of the article was How to Trade the War, Avoid Gimmicky Strategies and Overheated Assets. We see this all the time in periods of turbulence, whether it was the financial crisis or COVID or the Fed raising rates or now a geopolitical event. You're going to be blitzed with opportunistic marketing messages from the financial industry, my industry. So I'm talking about my own industry here. There's an old expression, Wall Street is great at selling you what you want to buy. So in other words, if you are worried about Iran and oil, outcome products that the investment industry knows that you're going to purchase to kind of hedge that risk. We've seen this all the time. And the problem with it is you end up chasing yesterday's trade. I mean, the assets most likely to benefit during wartime are already expensive. Already expensive. I mean, look at how defense and aerospace stocks have performed over the course of the last few weeks. Look at how oil stocks have performed. Here's the problem. I was just looking at a couple ETFs, exchange-traded funds that own aerospace and defense. The two that I saw were trading at, on average, 41 times earnings over the past 12 months. That's about 50% costlier than the S&P as a whole. I looked at a couple of the big energy ETFs. For the last really 23, most of 24, they were trading at 8 to 10 times earnings. Now over 22 and a half times earnings. So it's not that buying, an oil stock today is a disaster. I'm not saying that. I have no idea where oil is going to go in the next few months, nor do I know where oil stocks are going to go over the next 6 months. But I would tell you a lot of the gain, if you will, the benefit from higher defense spending and oil stock earnings is already priced into these names. Okay? So just be careful when you see something that's presented to you or you see it in an ad saying, hey, because it's going to sound great. Hey, of course I should buy oil stocks right now. Oil's going up. Oil's, around $100 a barrel. Doesn't mean it's going to be a good investment for you. And maybe you should be looking at some of the things that are on sale. All right, let me shift gears a little bit. I do want to frame the backdrop a bit. And some of this might be a little bit repetitive because I know Chase talked about some of this last week. I certainly talked about it a couple weeks before. But there's so much misinformation out there that I think it is important to kind of understand the reality of certain things. And of course, we can talk, again, with the caveat that things could change, in 2 days from now if somebody bombs something that isn't yet been bombed. But what do we know so far? The only energy infrastructure that has really been compromised in a significant way is natural gas. Qatar has indicated that the repairs on their facilities might take as much as 3 to 5 years, which leaves about a sixth of liquid natural gas exports offline in the interim. That's about 3% of global supply. So that's a pretty big deal, especially in the sense that, not only for that supply being disrupted, but it also forces people dependent on that, namely a lot of the Asian countries, to burn more diesel fuel to offset that, right? Which kind of has a corresponding effect on the prices of that commodity. So I don't think it's any accident that if you look at the oil futures, which I do on a routine basis, I don't necessarily look at what's today's prices, but I look at what the market's saying about late 2026 and early 27. They're suggesting oil prices are going to be elevated for longer than people think. Okay, so that's probably the biggest takeaway from what's happened so far. And by the way, I want to give credit to Larry Adam, drawing from some of his research here. So how does that affect us here in the United States? Well, obviously the biggest input, or at least the most visible input, gas prices, right? And it's interesting that we pay some of the lowest prices for gas in the world. And you know that if you've rented a car in Europe or in other countries. And it's not necessarily correlated with the fact that we have a lot of our own production, right? Otherwise, Norway and Canada would have really low gas prices, which they don't. A lot of it has to do with taxes. The main source of variability in gasoline prices around the world is the level of fuel taxes. If you've traveled in Europe, you know that fuel taxes are very high. They're trying to spur a high level of electrics, so they are directly de-incentivizing driving gas engines. And fuel taxes in Asia tend to be a little bit closer to U.S. So just to kind of quantify that, the federal tax in gas is about a little over 18 cents a gallon, and that stacks on top of state-level tax. So the question is, what can governments do to kind of mitigate this impact of higher gasoline prices? Well, one thing they can do is a tax holiday, and that's being debated right now. I will tell you, a lot of states like Florida, for example, have pushed back on that because they think it would drive a significant hole in the state budget, but that's certainly one thing that they can do. Another thing that they can do is, and in fact, I think this is happening, if I read it correctly, fuel companies are required to change the gas formula during the summer driving season to reduce smog. That comes from the EPA. If they were to waive that, that would result in savings of about 10 to 30 cents a gallon. So my guess is that will happen. Makes for a pretty smog-filled summer if you live in the big city, but that's probably what will go on. You're already seeing some countries in the world actually go to a 4-day work week to reduce commuting. I don't think that's going to happen here, but that's another option. So the question is, maybe it's the $64,000 question, how would a prolonged fuel price increase affect consumer spending? Well, as it stands today, again, this is according to Larry Adams, gasoline accounts for only about 1.7% of the typical household budget. Obviously, there are exceptions to that, but 1.7 in aggregate. That's less than half the share of 3 decades ago. A lot of that's due to improvements in fuel economy, much better fuel economy, and of course the adoption of electric vehicles as well. Back in 2025, only 10% of automobile sales were electrics. I would expect that to increase this year. Now, also keep in mind that we're seeing bigger tax refunds than we've seen in a while as a result of the tax bill from last year. And remember, that was a back-end loaded stimulus. There was no stimulus up front, but because of the deductions that went into place, it's back-end loaded, right? So we're just starting to get the stimulus from that now. And of course, a lot of people don't file until the last day in April, so they may not get refund checks until late April, early May. According to Adams, the net refund should offset higher gasoline prices unless gas is over $4 a gallon extending into 2027. Refund should offset a lot of that gas price increase. So for that reason, it may not be as big a drag here in the United States as you think. But of course, and so far I would say, even though consumer discretionary stocks are down a little over 10%, the market's worried about the impact, but we haven't seen it yet. Passenger numbers at TSA checkpoints, up 3% year over year. Retail sales, restaurant booking, Visa spending data, all running well ahead of a year ago. Again, that could change, but for now, we have not seen any major impact. But people do start to worry about recession if this thing drags on. So I mentioned that consumer discretionary stocks are down, and there certainly are numerous historical precedents for oil price spike to lead us into recession. I mean, the 73-74 oil embargo, Gulf War in 1991, 07-08, that was a contributing factor to the financial crisis. Now, certainly the spike in oil was not the only reason for those downturns, just a contributing factor, but it is something that we're going to have to think about. Most recently, remember, when the Russia-Ukraine war broke out, oil spiked a good 30% above where it is today. Went up to $130 a barrel. But we never went into recession as a result of that. Yeah, you had a crappy first quarter in terms of GDP. I think it was negative 1%, if I recall correctly, and basically flattish in Q2, but did not take us into a recession as a result of that. By the way, we still didn't go into recession even when the Fed was raising rates from 0% to 5% later in the year. I think the point I would make is that oil is not the factor. Generally, where we've had market and economic downturns, it's where there have been other issues going on at the same time. So, for example, that when with 9/11, we were already in recession at that time as a result of the dot-com collapse. That was just a contributing factor. So what's the read-through for Fed decision-making? And I know Chase talked about this a bit last week. Certainly, we know that oil can be inflationary. I don't think that's a big mystery. But there's other sources of inflation as well. A big source of it's going to be fertilizer. I mentioned this 2 weeks ago, that the Strait there of Hormuz is a major traffic vehicle for fertilizer, which, of course, is a significant input into crop profits and therefore crop prices. So I would expect some real food inflation over the course of the next 6 to 9 months. I mentioned helium. That's a pretty big byproduct of liquid natural gas production. Qatar is the second largest producer of helium in the world. That's a key input for microchip fabrication. So I don't think it's an accident that chip stocks have come under pressure. They're going to face some supply chain disruptions, some possible threats to their margins. So you put it all together, and I've read different estimates from different places, but here at Raymond James, they think that headline inflation on a year-over-year basis is likely to increase about 1% versus the kind of pre-war forecast over the next few months. The big question, again, more than a $64,000 question is how protracted of a move is this going to be? right? Is it just a one-time thing, or is it going to be like COVID where, remember that whole thing from the Fed that inflation's going to be transitory? Well, it wasn't transitory. It lasted, a couple years. Is it going to be that type of situation? Generally speaking, we saw it with Ukraine. Energy prices do stay higher for longer than you think, but the base case right now is this is not a 2 or 3 year thing, okay? That second half of the year you start to see inflation come down. We'll see if that is, wishful thinking or not. But in the meantime, it's not just helium, it's not just fertilizer, it's not just oil. We've seen coal prices, palm oil, iron ore, diesel, sulfur, rice, all kinds of commodity prices go up. But again, I think we need to keep some perspective. Oil prices have gone up 50% recently, but we're still, as I mentioned, about 25 to 30% below where we got to in 2022. Also remember when, in that period, we were already dealing with like 8-9% inflation coming out of COVID. So the backdrop was much more inflationary coming into that war than what we've seen today. And granted, inflation has been above the Fed's target zone, but nowhere near sort of where we got to in 2022. Not to mention that energy is just a smaller percentage of the inflation index than it used to be. I mean, right now, according to Larry, energy is only about 6% of the consumer price index. It was over 10% of the index as recently as 2012. So we'll see. I think the hope is, and I know the Fed has come under a lot of attack, but to their credit, I think they're taking kind of a wait-and-see attitude, which I think is appropriate. They want to see exactly how this plays out, what the duration of this war is going to be. Other countries are, quite frankly, I think being a little bit more reactionary. I mean, it was amazing. I was looking at the Bank of England, some of their commentary, and specifically I was looking at their bond futures. Their bond futures went from pricing in 2 full rate cuts this year to 3.5 hikes. 2 cuts to 3.5 hikes in less than 2 weeks. Again, my crystal ball is no clearer than yours, but it certainly seems to me that the futures markets and the bond market, for that matter, are maybe being a little overreactionary here. And the hope is that things settle down a little bit at some point. But in the here and now, that's been one of the biggest issues with this market so far, is that there have not been any kind of places to go other than cash. We've talked about stocks. I'll talk about them a little bit more in a minute. Treasuries, the 10-year Treasury yield right before the war broke out had gotten down to 3.9%. It's now pushing 4.4%. So bonds in general, Treasuries specifically, have delivered negative returns since this war has broken out in the Middle East. So that's been unfortunate because you just haven't had that sort of risk offset. Now, again, if you own individual bonds, I don't think this should be a big concern to you. If you had a bond at 100 cents on the dollar and now it's at 95 cents or 96 cents on the dollar, if you own the individual bond to maturity and it doesn't default, which hopefully it doesn't if you own high quality, you're going to get your dollar when it matures. So these are just paper fluctuations. So that's one of the reasons why we've emphasized over the years individual bonds, because we have a high degree of visibility, transparency into what our returns are going to be. Within the market, small cap stocks that had just started to look like they were turning the corner after years of underperformance have gotten killed. Not a big surprise. They tend to be much more interest rate sensitive, much more kind of risk sensitive in general. What's also unfortunate, though, is some of the more defensive areas of the market, the areas that, the quote-unquote widows and orphan stocks, the things that people flock to when times are stressed, have not worked, at least in the short term. For example, companies with relatively high dividend yields, they tend to move inversely with rising interest rates. So like bond prices where, they're falling as yields rise. So things like utilities, consumer staples, they have not performed well. Not to mention a lot of those companies, particularly the ones that produce packaged goods, for example, like the staples, they're not in a great position to be able to pass along higher costs to their customers. They tend to be in really kind of inelastic businesses where they can't raise a box of cereal from, $5 to $8 and have people still buy that cereal, right? So they just don't have a lot of ability to pass those along. Really, they have little choice but to absorb those sudden cost increases, which results in margin pressure. On top of course, all the sort of the margin pressure that's already, in existence. So that's probably the reason why some of those more defensive areas have not done particularly well. But again, it makes our lives as investment managers and your life as an investor that much more challenging when there's really no safe haven at this point, other than cash. So, just back to the market for a second, the S&P 500 as it stands, depending on the hour that you listen to this, is down somewhere between 6 and 9%. I'm just being conservative because things can fluctuate somewhere between 6 and 9% from the peak. Remember, again, I like to put things in context. Each of the past 3 years, we've seen a bigger intra-year drawdown. We saw a 10.3% sell-off in 2023. This is according to FactSet. 8.5% drop in 24, almost a 19% drop last year. And in each of those 3 years, the market had a double-digit return at the end of the day. All right, so again, this is not unusual. And remember what I've also been saying for the past 6 months, that midterm election years are almost always the most volatile of a 4-year presidential cycle, with an average double-digit drawdown at some point during the year. So, of course, the circumstances change with every presidential cycle, but this is not unusual. The fleas that come with the dog, as the late, great Rick Malone used to say, our founding partner. So, we'll see how things turn out. I think the one other thing that I would kind of highlight here is at the end of the day, and I've been consistent on this, earnings are going to matter more than anything else. So we can talk about the Fed, we can talk about inflation, we can talk about oil, and we'll continue to talk about all those things because they're certainly affecting the short-term outlook. But the thing that I'm going to pay 97% of my attention to or the outlook for corporate earnings. And so far, the forecast for earnings for 2026 and 27, this is from FactSet, have held up very well after trending, higher for the last couple years. I mean, Ben Snyder over at Goldman Sachs this week, he came out and said that AI investment should offset the drag from modestly weaker economic activity. That was his quote. He thinks AI investment spending will contribute roughly a third of S&P 500 earnings growth this year. And by spending, I don't know if he necessarily is just talking about the big guys, Google buying from NVIDIA, for example. He's talking about spending at the corporate level. Companies like Raymond James, spending on AI. Take it with a grain of salt. It's something that we're going to have to keep a close eye on, but so far, earnings estimates have not come under fire. And that was the case last year, remember? In the face of tariffs and everything else, the S&P still had a good year. Why? Because corporate earnings growth was up in the mid-teens. That's what's going to matter. And by the way, technology specifically, I've talked a lot about the fact that money has rotated out of technology into other areas of the market. Despite significant underperformance by the tech sector this year, we're still seeing consensus estimates, according to FactSet, for almost 40% year-over-year technology earnings growth for this year. Fastest pace since 2010. And estimates have actually gone up 14% just since February as the stock prices have come down. I said this, I think 2 weeks ago, that I think some point people are going to look up and say, why am I paying 35 times earnings for some consumer staples company growing at 2% a year and only 18, 19, 20, 22 times earnings for a company growing at double digits? We're not there yet, but this is why I've been very reluctant in our portfolios to sell tech and kind of buy what's working now, because things could easily trade the other way 6 months from now. That's why we continue to espouse portfolio balance, not just chasing the momentum. And I would also say, just a note on bonds. I think bonds are really interesting to consider right now. I mentioned how interest rates have gone up a fair amount just in the past few weeks. More specifically, short-term bonds have gone from pricing in at least a couple rate cuts this year to, believe it or not, actually pricing in a rate hike. This is just within the last 2 weeks this has happened. So, hey, maybe that's the case. Maybe this, as I mentioned a few minutes ago, maybe oil prices stay elevated for longer than we think. Conflict remains elevated for longer than we hope. And inflation becomes a bigger problem. But look at the flip side of this. What happens if these oil prices, food prices, already a sluggish labor market, maybe AI spending slows down? What if that leads to the economy slowing down the second half of the year? Hopefully not into a recession. But there's a pretty good argument to be made that bond yields, bond interest rates actually come down. Could come down significantly if they're pricing in an economic slowdown. So you may have a window, and I say may because I don't know anything more about the future than you do, but you may have an opportunity here to deploy some money into bonds, both short and longer term bonds. Tax-free bonds are particularly interesting because the yield curve there is quite steep, meaning longer term municipals are trading much higher yields than shorter term municipals. So if you are willing to go out a little bit further, and let's say you're in a pretty high tax bracket, maybe the max bracket, you can lock in taxable equivalent yields now of well over 6%. In some cases, 7, 8, 9%, even on investment grade paper. Last thing I wanted to say, I just wanted to have a quick note about precious metals. One thing I mentioned how there haven't been any safe havens really other than cash over the past couple weeks. We'll throw precious metals into that mix because, of course, gold had done very well this year. We have now stripped out all the gains. Gold is back to where it was at the beginning of the year. Silver is down significantly over the course of the last couple weeks. Part of that could be the prospect of higher yields, driven by inflation concerns, makes it less attractive to hold gold because it doesn't pay any yield, right? Could just be, retail investors losing interest. Remember, gold was started to trade like a meme stock, right? Like it started to trade like crypto. But the other explanation is maybe countries aren't as interested in buying up gold for their exchange reserves at the same time that they need to deal with a massive oil shock. It was evident that a lot of the increase in metals prices was coming from central banks around the world diversifying their exposure away from the dollar. Maybe they can't do that anymore, or maybe they even have to sell into this to be in a more liquid position. Lesson is, don't chase trends. People who piled into gold and silver 2 weeks ago are now looking at 20+% losses in some cases. Now, again, maybe not permanent losses. Maybe those metals rebound in a few weeks, few months. I have no idea. But whenever you start orienting your portfolio towards what's working in the here and now, which is what the vast majority of retail investors do, often doesn't work out. All right. Well, I can promise to you that Chase and I will continue to keep you abreast of what's going on. By the way, our colleague Greg Smith will be hosting next week. He's our head of financial planning. I think it's always good to do a planning show once every few months because it gets you away from the day-to-day, focused back on the big picture, which ultimately is going to be a lot more important. Stay tuned. I don't have a lot to say on the individual stock front, but I do have just a few quick thoughts. Back in a minute. Remember when AI stocks went up every day and massive tech spending was rewarded? How do you separate an abrupt shift in sentiment from business reality? Are now weak tech names opportunities or to be avoided? Tune in every week as we discuss the latest financial trends and what investors need to know. To filter out the headline noise and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Just have a few quick stock thoughts. I don't have a lot because really I'm more focused on kind of the macro picture at this point. The market's moving with macro themes, geopolitics, not so much individual stock news, but there has been some. We'll talk a lot more about individual stocks, of course, as we start to get the first quarter earnings. It's coming up on the end of the first quarter here. I've talked about Uber a fair amount, symbol UBER. By the way, just remember, if you're a client and you've worked with us for some time, I think you can feel comfortable that we've done our due diligence and feel that these positions are right and suitable for your portfolio. If you're not a client, please do your own homework. I can't manage your money through the podcast, through the computer. Also consider that the names I'm going to mention, I own personally, and we own for a lot of our clients, Uber included. I own that, and our clients own that. You can consider that a conflict of interest. But back to Uber, I've spoken about them a lot. Stock has really been under pressure for most of the year, been kind of mired here in the 70s after trading up close to 100, at points last year. I think it's such a competitive space. I read the other day that Google's CEO, his compensation is now going to be directly tied to growth of Waymo, their autonomous vehicle division. Of course, Tesla has been very aggressive about getting into the automated taxi, robo-taxi business. So it's a very competitive space. Investors are just trying to figure out who's going to win. But Uber's looking a lot to me like an AV winner, autonomous vehicle winner. There was a really good piece from Evercore, and they just talked to the point that Uber has been making deal after deal and really diversifying their exposure, not only through car companies, but all kinds of platforms. They just struck another deal just in the last week with Rivian. You probably know Rivian. They've become kind of the sexy electric vehicle. They're going to partner with them, and Uber is going to invest a bunch of money into Rivian over the next 5-6 years. They're going to be launching in a couple major cities over the course of the next 6 months. I think they're starting in San Francisco and Miami. They had already struck a deal that I mentioned 2 weeks ago with Amazon. They're actually the first external rideshare partner beyond the Amazon app for that business. All kinds of other deals too. They struck one with NVIDIA, deploy a global fleet of NVIDIA software-driven AVs. So they're striking deal after deal after deal. But here we have Uber at only 12 times free cash flow, price to earnings ratio of about 17, pretty sharp discount to the S&P 500, makes them one of the cheapest companies of that growth rate and that size in the S&P 500. It reminds Evercore, this is their words, not mine, much of Google a year ago. Google was sitting there at 16 times earnings. People were questioning their AI footprint. Stock now trades at 24 times earnings, 25 times earnings, and went up like 60% last year. That's not a price prediction for Uber, but they see it as a similar type situation. They have significant margin expansion potential, strong free cash flow generation, accelerating user metrics, very good footprint in food delivery, which is also a growing business. So just seems like the ability for Uber to be a survivor, a winner, and a net beneficiary of the trend towards robo and taxis is not really reflected in the stock price. So there are risks, like I said, mostly competitive risks, Tesla, Google, what have you. But I think, again, Uber's strategy is to kind of combine forces with a lot of the major players, and hopefully that pays off. But I think it's certainly worth considering. The other thing, I'll probably do a whole show on this at some point. I haven't really talked much about the concerns that are out there with private credit, and the fact that a lot of the big banks extended loans to private credit companies so they could have the capital to make loans to businesses. So the big banks definitely have some exposure to what's going on in private credit. And again, I'll look at that situation a little bit more detail on a future show. I know I was talking to Chase about that. He would like to do that as well. But in the meantime, a lot of these big bank stocks have gotten really reasonable. And I would just highlight Capital One. Capital One's a big name here in our local area, huge complex just off the Beltway in Tyson's Corner. As you probably know, they have merged with Discover Financial Services, one of the biggest credit card companies. That was a $35 billion merger. They are just starting to realize the synergies from that, okay? And I do think that Capital One, not only might they have some private credit exposure, but it's probably minimal. The bigger issue is they have a lot of direct consumer exposure. They don't have some of the other lines of business that a Citigroup or a JP Morgan would have. So they're more directly tied to trends in consumer credit, consumer spending. So there's that kind of recession / hit to consumer discretionary spending risk. But Capital One, I think, reflects a lot of that. So you've got Visa and MasterCard, which I like, by the way. I'm not down on Visa and MasterCard, but they're both trading over 20 times earnings. Capital One is now trading about 9 times next 12 months estimates. That's far and away the cheapest multiple that they've traded at since I've been, I don't know, it has to be at least a decade since they've been this cheap. So again, the risks are more kind of macroeconomic risks. Does consumer spending tail off? Do we see more defaults? But if you're willing to be patient with that and willing to be patient with their merger and the synergies that are unfolding from that, I think that the valuation at this point is not very demanding at all and could be worth at least a look from you. So again, stay tuned for more news on the individual stock front, particularly as we start to get the first quarter reports. Those are coming up in the next couple of weeks. In the meantime, the market seems to care more about the headlines, what's coming out of Iran, what's coming out of the White House, and we'll continue to make sure we keep you abreast of those things. As always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.